Good afternoon, everyone. Welcome to Aero Services Credit Union. Let's talk money, habits for life. My name is Anne McPherson, and I'm thanking you on behalf of Aero Services Credit Union for joining us today for this webinar. This afternoon, we have Ms. Arlene Popplewell, who is going to be conducting the session with us and going to be giving us some pertinent and relevant information in terms of money and the habits for life. Ms. Popplewell is a graduate of Howard University, and she has worked in the public and private and quasi-legislative sectors during her extensive career. In 2019, she retired from the Trinidad and Tobago Securities and Exchange Commission, where she held the position of Director of Corporate Communications, Education, and Information.
I Lied to You, written by Ludwig Göransson. Now, in the movie, the song is about preacher boys.
A major part of her role there involved the development and implementation of innovative and financial literacy programs designed to assist persons in making informed financial decisions through knowledge and skill building. In January of 2024, she completed a contract where she served as a communications advisor to the Permanent Secretary of the Ministry of Tourism, Culture, and the Arts. Ms. Popplewell has been a facilitator in the Central Bank's National Financial Literacy Program since 2019. Ms. Popplewell, to you.
Thank you very much, and good afternoon, everyone. Just a couple things I need to say before I start. One, I am not a financial advisor, so I will not be giving any financial advice in the sense of sometimes persons ask me, where should I put my money or what should I do with my money? The information that I'm providing is financial literacy type information to help you make an informed choice based on your own personal circumstances. The other thing I need to state is that I do suffer with a post-nasal drip. And sometimes when I'm talking, I will get a tickle in my throat, and sometimes I have to pause and have a drink of water. It is not meant to be rude. I'm simply letting you know that if you see me stop or if you hear me coughing, that's what is going on. All right. So let's get right into it because we have a lot to cover. And let's see. All right. Are you seeing my slide?
Yes, we are.
Okay, great. All right, so let's get into it. Let's talk money habits for life. The agenda is on the screen. We're going to be talking about money mindset, financial goals, budgeting, saving, investing, and managing debt. And I'm going to make sure you have seen this slide advance, yes?
Yes.
Good. All right. So, question I like to ask persons, what is your money mindset? Just pause and think about that for a minute. What is your money mindset? Some people don't know what that means. So your money mindset is your very unique attitude towards money, how you think about it, how you act with it towards it, what you believe about money. It informs how you can manage, save, spend, and ultimately invest your money as well. So, do we have financial goals? I think we all have financial goals. But what's the purpose really of financial goal setting? The purpose of financial goal setting really is to develop an actionable plan. And it helps you to make informed decisions about your money, especially in relation to meeting short-term, medium-term, and long-term goals. Financial goals help you set a direction and focus. It helps you to set priorities. It also motivates you because if you have something in mind that you want to achieve, you tend to want to achieve it, you will get motivated. And as you achieve more and more of your financial goals, the motivation just keeps going for you to achieve and achieve more. It also holds you accountable because if you set a financial goal and you're being lazy about meeting it, it means you won't achieve what you have set out to. And we generally like to succeed at what we set out to do. So it holds you accountable and it motivates you. When people talk about financial goals, generally, these are some of the things that they mention. Education, buying a car, buying a house, going on vacation. Some people talk about retirement. I hope all of us in the room have considered retirement as a financial goal. I, however, would like persons to reframe how they think about their financial goals. I want you to think of accumulating wealth. I want you to think about converting wealth to income. I want you to consider transferring your wealth to your dependents and ultimately protecting that wealth, both for yourself and for them. So I always like persons to reframe how they think about financial goals. At the end of the day, this is really what it's about. You want financial stability and you want financial security. But of course, when you're doing goal setting, you must be smart about it. Smart here means specific. So you must be clear and concise in your goals. Measurable, you need to track your progress. Achievable, it should be challenging, but achievable. And of course, it must be important to whatever you want to achieve in life. So it must be relevant. And no goal should be set without having a clear start and an end date. So it must be time-based. But life happens. So I always suggest that persons have a plan B. Your plan B happens when you have an adaptable financial goal. Something may not work out the way that you plan, and therefore you need to either change the time in which you want to achieve it, and sometimes we may just have to shelve that plan and think of another plan. So always have your plan B. So I move now to budget. As you see on the screen, the person has money, and that money is being stretched in all types of directions. How many of us actually budget? It'll be interesting if you all could put that answer in the chat, and Anne could probably tell me at the end how people, how many people actually said that they budget. But the next question I like to ask is, how many of you stick to your budget? And that usually is a different answer. So to budget or not, some people are reluctant to budget. They consider it a headache. I have actually been in a session where somebody told me they don't make enough money to budget. But that person was sitting down with a Rituals coffee cup, and they were saying, so that was a while ago, they were saying they have to have rituals every day. And every day of the week for 4 weeks out of the month. And I asked them just to multiply how much it costs. And then I said, do that for a year. And then that person was, a little taken aback when they realized just how much money they were spending on just this one thing. But they felt that they didn't make enough money to budget. So a budget can do a lot of things. It helps you take account of income and expenses. It can bring you closer to financial security. It can keep your spending in check if you budget properly. And it can ensure that you have savings, whether it's for retirement or for emergencies or even to purchase something. You may have an expense that you're looking to do towards the end of the year. All of those things are helped by budgets. So your budget can help you figure out your long-term goals, your medium-term goals, and your short-term goals. It actually forces you to map out what can I do when and keep track of your progress. And that's the way that you make your dreams a reality. So a budget can do a lot of things. Now, a personal budget is your financial plan. And it determines how you allocate your income and how you manage your expenses in order to achieve those financial goals, obviously over a specific period of time. So when we're looking at budgeting, really, it's a balancing act between your income and expenses. Ideally, your income should be more than your expenses, but sometimes we find out It doesn't work that way all the time. So we need to do something to, bring that in check. So when you're looking at a budget, it's very simple. It's a spending or a financial plan, and it details how much money you have coming in, which is your income, how much money you have to spend, which are your expenses, and over what period of time. Let's look at sources of income. Every time I talk about income, most people think of salary. A salary is your fixed sum of money that you receive every week, fortnight, month. Some people get paid daily. And it's the money that you get for doing a particular job. But there are other sources of income. You may have skills that you've monetized. So you could be a barber, a tutor, a personal trainer, a caterer, a hairdresser. You could sell products. All of those can provide you with income. Now, some persons actually have a salary and they monetize their skills by using a side hustle, and they get additional income, all of which should be budgeted. Some of us get social grants, receive tax refunds. Some public officers are anticipating a back pay. And for those of us who are members of credit unions, you get dividends from your credit union after your AGM. All of that is to be budgeted because it's sources of income. For those of us fortunate enough to own property, you can consider that an investment, and you can ultimately get profits from that if you decide to sell it at more than you would have paid for it. You could also buy securities, which provide you, the owner of the security, with a share of the profits when the company does well. And I'm going to talk a little bit more about investing a little later on. And for those of you, like myself, who are over a particular age, you actually may be in receipt of a pension where you would have put aside money over the years of employment, and your anticipation is that at the end of this particular period, you will be able to sit back, relax, and enjoy the fruits of your labor. So the other side of the coin is expenses. Expenses can be fixed, variable, or periodic. Now, fixed expenses are the same amount each month. Variable expenses, they're paid each month, but the amount could change, and periodic may be quarterly or annual. So examples would include, for fixed expenses, rent and mortgage. For variable expenses, anything that has to do with usage. So your grocery bill, your electricity bill, things like that. And periodic expenses, if you think of annual expenses like, let's say, car insurance, or if you have tuition fees per semester or per term, anything like that, periodic. So getting deeper into budgeting, what is it you want your budget to solve? And I want you to look carefully at these questions, because for some people, it is all of these. For some people, it might just be some. Do you want to break out of the cycle of living paycheck to paycheck? I was there for a long time. Do you want to get out of that? I was there as well. Do you want to curb impulsive spending? Do you want to save up for a large purchase? And do you want to save for retirement? Those are some of the questions that you need to ask in relation to your budget. So, what do? 1, make a plan. You need to document all of your income and organize and prioritize all of your expenses. And that includes your fixed costs or any recurring payments that you owe, and calendar expenses. I just want to talk about this a little bit. We all know that Mother's Day is the second Sunday in May. We all know that Father's Day is the third Sunday in June. We all know Christmas is the 25th of December. However, the malls are always filled to capacity the day before these holidays, largely because people have not budgeted and they may be waiting until the last minute to actually find the money to purchase some of these items. So you make your plan, you put down all of your calendar expenses, your fixed costs, and you determine what your financial goals are. So you're prioritizing your financial goals within your budget. What do you do first, next, and later? And systematically work towards achieving them. What about controlling overspending? The way to treat with this really is to track your spending. Not a lot of us track our spending. I remember when I used to go to the mall with a certain amount of money in my wallet, and I will go through the mall, spend a couple hours, and I come back home and I look in my wallet and I'm like, where did all my money go? And when I take out some of those little chits that you get from the cash registers and you add it up, you realize, oh, that's where I blew that money. We don't even track our discretionary spending, like buying snacks or coffee, like the girl who bought the rituals. So if you track your expenses for at least 1 month, you can get a pretty clear picture of where your money is going. What about making debt reduction a priority? A lot of persons are drowning in debt, and it's important to apportion at least part of your budget each month to paying off that debt. Emergency savings is very important, and during COVID, a lot of persons realized just how important this is. Life happens. So you should have an emergency fund in the event something happens. It could be that you're going down the highway and your tire blew out, or you have some unexpected health scare and you need to go to the doctor, or one of your children needs to be taken to the doctor. It could be anything. Your washing machine conked out on a public holiday. That happened to me once. Do you have the funds put aside in order to treat with these emergencies? Now, the financial gurus suggest that you should have at least 6 months take-home pay set aside just for emergencies. Now, I know some of you are going to be asking, how am I supposed to do that? You start small. Figure out how much you could realistically save each month. If that's $100, if that's $200, you put that aside and you save it and you repeat. You just repeat, you repeat. You continue to track your expenses. You're monitoring whatever you're spending money on, but you keep putting aside a certain amount of money. Once you reach, let's say you say, I'm going to save 1 month at least. Once you reach that figure, you continue to do again and again until you have that 6 month. But I always recommend that persons put that money somewhere that at least it will be still giving them some type of return on your money. So under the mattress is not an option. It's also important to budget for fun. We are Trinbagonians and we have a joie de vivre. So we need to also cater for having fun. It could be as simple as going to the beach with some friends. You might cook a pot of pilau, or you might decide, okay, I'm going to buy some bacon shack or shrimp and fries or whatever it is. Put aside money in your budget for those. You might be even going to a movie. Put aside some money, but make sure that your essential needs and all of your savings goals have already been met. Cater for leisure activities. Retirement planning is very important. I do not want anybody to be in this situation, as we see on the screen. You should start saving for retirement from your very first paycheck. I will say that again. You should start saving for retirement from your very first paycheck. But if you haven't, please start now. If you have an employer-sponsored retirement plan, take advantage of it. What worked for me is making my retirement savings automatic. So I did a standing order, and as before the pay actually hit my account, it went somewhere else as a savings. Also remember, when you are advancing in your career and you're getting pay increases, don't keep putting aside the same amount of money. Adjust it upwards. It's also important to have a little wiggle room because there's a budgeting method I'll show you that is actually exact. It apportions every last cent. But if you can do in your budget a 5 or 10% contingency, include it as a line item. And in the event that you don't use it, you can put it towards your emergency savings or your retirement fund. And of course, I talked about flexibility already. You need to make your budget flexible. You need to update it as your life experience changes. You need to put it as a note in your calendar too, a reminder. So whether it is every 6 months or whether it's every year, you can always review your budget. You may find that you can actually save more or spend more. Or on the converse, you may need to spend less, but it's important to regularly review your budget. So I'm going to give you some very simple budgeting methods. I know that you can go on the internet and you can get all kinds of apps and Excel spreadsheets, and there are lots of different budgeting tools that you can use. But I'm going to keep to some very simple ones. The first one being the cash envelope method. It's a very, very basic method, and it simply assigns categories to envelopes. So for instance, transportation or gas, groceries, rent, utility bills. You just put the name on the envelope and you divide your income according to the categories. So if you know you spend $500 a month in transportation, you put $500 in the transportation envelope. If you know you spend $1,000 in groceries, you put $1,000 in the grocery envelope, and so on. This method is geared to the overspender. It helps to curb your overspending because you see exactly how much money you have per category to spend. In the event that you want to spend more than that, it means you have to take it out from another envelope. In other words, from another spending category, which then means you have less to spend in that category. So sometimes the envelope method helps us because we decide, oh no, I'm not going to take it out of there. I'm going to just manage with what I have. The con for the envelope method, of course, is nobody wants to be walking around with a lot of cash. It's a risk for theft or loss, and going to the ATM every minute is a hassle. But one of the things I recognize is we have an attachment to the physical money. It's so easy to swipe your card and you don't even realize how much money you've spent. But when you actually have to take out that cash and hand it over, sometimes you think twice. All right, so this quote here is from Warren Buffett, who said, "Do not save what is left after spending, but spend what is left after saving." This particular budgeting method is called the pay yourself first. What you do is determine how much money you want to save, whether it's for your emergency fund or retirement. You put that money aside first. And then you spend whatever is left based on your wants and needs. This is best suited to the failing saver, which I was. Very often, after we pay for everything that we have to pay for, we don't have enough money for our savings goals. So this method makes you save first and spend after. Then there's the 50-30-20 budget rule, where they recommend that you spend 50% of your income on needs, 30% on wants, and 20% on savings or debt reduction. Now, I just want to let you know that you can change the 50-30-20 to any percentages you want. The key thing is that the major part of it goes to your needs, the second largest part to your wants, and the least to your savings or debt reduction. So this is suited to your beginning budgeter, your get out of debt budgeter, and the keeping it simple budgeter. And then the zero-based budgeting is where you apportion every single cent, every single dollar to a task. So in this case, this person's income here is $25.75, and they've apportioned every single cent, including contingency. So if you want to take control of your money, this method works for you. You see exactly where your money is going, and it helps you relieve stress because you don't even have to make decisions ahead of time. You already know that everything is handled. So this screen just shows some of the challenges of each method. So I'll just leave this up here for a little bit for you to see while I take some water. All right, so let's move on to the importance of saving. Saving is a term that really just means putting money aside for the future. And it is appropriate for short-term goals. Where do we save our money? We save our money in bank accounts. And bank accounts are insured by the Deposit Insurance Fund for up to the sum of $200,000. You can visit this website to get more information of how that Deposit Insurance Fund works. So it is dictt.org. We also save money in credit unions. And we all know that credit unions are not-for-profit financial institutions that bring together borrowers and savers. And they are owned and controlled by us, the members. As I mentioned before, after the AGM, any profits that the credit union has made, some of those profits are shared with the members via a dividend payment. Credit unions also have a deposit insurance fund that covers the unencumbered shares and deposits for members. So, saving is a long-term goal. That's a myth. Saving really is a short-term goal. Some people believe that putting aside the same amount of money each month will create the significant nest egg for retirement. Now, saving is only the first step because remember, savings can be eroded by inflation. So you must invest your savings in products that can provide a return that can beat inflation. And I know once you're a member of a credit union, the credit union will have different products that they can offer you that can help in this regard. Another financial myth: I should start saving for my retirement when I'm in my 40s. Fact is, the sooner you start saving, the more that you can benefit from compound interest. And this is the interest that is calculated both on the initial principal and any accumulated interest over the period. So that means that your money grows exponentially over time. So we've talked about saving, so let's talk about investing. Investing is allocating money to own an asset. The buyer anticipates a future return either because the asset will generate some type of income, because the asset can increase in value, and therefore your net worth is increased. And of course, investing is over a period of time. So investing is more appropriate for medium and long-term goals. Remember, I said saving is a short-term goal. Now, there's a difference between investing and saving, and people sometimes use the terms interchangeably, but they are not the same. Investing has an element of risk, which means they could lose value. And very importantly, investments are not covered by the Deposit Insurance Corporation. So that is a major difference. Now, let's look at the risk return in the trade-off. Everybody has a different appetite for risk. I am risk averse, There are some of you among the audience who may be risk averse, and there are some who are risk takers. Understand that the more risk you're willing to take, the higher the potential rewards may be. But remember, the higher returns that you may be offered come with a higher risk, that the value of your investment may fall. So really, when you're looking at investing, you should only risk what you can afford to lose. In other words, if you're not going to be comfortable investing in this, whatever the instrument is, maybe you need to think twice, or maybe you need to look at an investment opportunity that has a lower risk. Remember that investments are volatile. They hardly ever go only upwards. They go up and down almost in a cyclical fashion. So like a cycle, it goes up, it goes down. So you have to understand your risk appetite and understand that investing is not for the faint of heart. You have to have belly to invest. You have to be willing to be in it for the long haul or the longer haul. And you need to not want to jump in and out and in and out. You need to invest your money with a particular type of time horizon. So you have to understand how long you're willing to invest for. The younger you are, the more risk you may want to take, simply because you understand that you have a longer time horizon to recoup if something were to go wrong. If you're 30 years old and let's say you invested $40,000 and after 5 years you lost part of it or all of it, you're 35 and let's say you expect to work until age 60, you may have time to recoup and get that money back, make back that money. But think of somebody who's 55 or 60 investing in something like that and losing it all. You're now a retiree. Where are you getting the money to put back? So the earlier in your investment journey, you have time on your side. I am not saying that if you're young, take risk. You must take risk based on all of the factors that you will consider. Now, there are some young people who are risk averse, and there are some old people who are risk takers, and you have to know where you are in your investment journey. The later on you in life, because you have less opportunity to make back the money, you may consider a safer or a less risky investment opportunity. So when we're looking at types of investments, there's direct investment in a business. You can purchase property, and property will include real estate, art, and precious metals. Or you can invest in securities, which is where you purchase shares in a company, and you're talking about things like stocks and bonds, etc. So we'll talk about investing in real estate. It usually is a very good investment option simply because real estate tends to appreciate in value over time. So it can be part of your overall strategy to build wealth. And because you are members of a credit union, your credit union has many loans that they could offer, including the ability to purchase your own home. So that in itself is an opportunity that you can look at. It's an investment opportunity, but you get an asset that is beneficial to you. Securities. They are investment instruments that have a financial value and can be used to create wealth, and they can be bought and sold on the stock market, but they must be registered with the Trinidad and Tobago Securities and Exchange Commission. And those investments include things like equities, debt instruments, and mutual funds. So the stock exchange is the marketplace where the buying and selling of securities takes place. So when companies want to raise capital, they come to the stock exchange, they put their shares for sale, and if there's a buyer, there's a seller, they agree on price, and that's where the trade happens. Listed companies are the ones that would put their shares on the stock exchange. They have to adhere to the stock exchange rules. In order to invest on the stock market, you must have a stockbroker who is licensed to sell securities. He works in a brokerage firm, and that brokerage firm facilitates the buying and selling of securities, and also provides investment advice. So these are the 8 registered stockbrokers in Trinidad and Tobago. I'm sure you're familiar with some of these logos. If anybody else comes to you to say that they are registered, you simply need to check the Trinidad and Tobago Securities Exchange website, which is ttsec.org.tt. If they're not listed there, then you need to be very cautious and probably not, give your money to those persons. Just do your research and check with the regulator to ensure that both the investment and the person selling the investment or proposedly selling the investment is legit. So equities are shares in the ownership of a company, and there are 26 listed companies that over $120 billion in our market. You can get dividends based on the stock's performance, or you can get capital gains based on the share value. So if the stock performs well, just like in the credit union, if they make a profit, they can give you, the owner, dividends. So capital gains, this simple graph or image will show you what I mean by capital gains. Let's say you bought stock X in 2019 at $40 a share, and you bought 1,000 shares because you got that back pay and you had $40,000 and you said, look, I'm going to buy some stock. So you spent $40,000. But in 2025, that stock is now valued $85 a share. That means your shares are now worth $85,000. Now, if you keep your stock, you will continue to get dividends based on the 1,000 shares that you have. If you sell your shares, you can make a profit of $45,000. But understand that the converse is also true. You could have bought your shares at $85 a share in 2019, and in 2025, the value of the shares went down to $40. You're still getting your dividends, but if you decide to sell your shares, you have what is called a capital loss because you would have lost on that deal. So a financial myth, investing on the stock market is just like gambling. The fact is that both involve risk, but investing is based on research and strategy, and gambling is just based on luck. Now, another long-term investment is bonds. Bonds are offered to raise money for capital projects, and either a government or a company is coming to us, the public, to lend them money for whatever capital project they intend to engage in. So you, me, we are lending money to this institution. Now, there are retail investors, and they're investors like the banks, mutual fund companies, credit unions purchase these bonds because they are a long-term investment opportunity. Now, key characteristics of bonds, there is the face value, which is the amount that you are lending. Now, I like to explain a bond like, think of a pizza. So let's say a company or the government says they want to have a $400 billion bond. I know I don't have $400 billion to lend the government, but I may decide to buy a tranche of that bond. Think of it as a slice of pizza. I may put that same $40,000. Somebody else will put 100. A bank may buy 100 million, and so on until the company or the government gets the full pizza, right? But you have a slice. So the par value or the face value is how much you lent, which in my case will be the 40,000. The length of time until the bond matures is the term. Now, I mentioned that the bond is long-term. So sometimes you have bonds that are 10, 15, 20 years. Some bonds may be 7 years. It's longer than 3 years or 5 years for sure. So the maturity date will be the date on which the principal is paid. Now, how bonds work is this. I lend, let's say the government, the $40,000, and they tell me that this bond is for 10 years. So in 2036 is when the bond will mature. The coupon rate is the rate of return, the rate of interest that is being paid. So let's say the rate of interest is 6%. So it means that if the return is being given to me every 6 months or every year, at that point, I get back the 6% on what I lent them. At the end of the term of the bond, so at the maturity date in 2036, they give me back my 40,000. So that is how having a bond provides you with income. Let's say every year you get that 6% interest return to you. They have your 40,000 and they're giving you the interest every year. And let's say it's 10 years. So for 10 years, you're getting that income every year. And at the end of the period, you get back your principal, which is the 40,000 I lent them. Now, you could sell your bond earlier than the maturity date. And there may be somebody who may want to buy it at a higher price than you paid for it. But sometimes people get themselves in a situation where they may need some cash for whatever, an emergency, a real emergency, and they may have to sell that bond, and it may not be at a higher price than they paid for it. But if you hold the bond for the duration, they are offering an interest rate that is higher than if you just put a deposit in the bank generally. So myths about investing: you must have a lot of money to start investing. Only wealthy people can invest, and investing is only for experts. So let's disavow you of that myth right now. There's something called a mutual fund, and in that, investors' monies are pooled by the mutual fund company. The mutual fund company will appoint a fund manager. That fund manager will invest your money in securities. And I just explained what securities are. So when you put your money in a mutual fund, they take the money and they invest it somewhere. And any returns that are generated are passed back to you, the investor. So there's a professional fund manager who is experienced, who will follow the fund's stated investment objectives. So you don't have to be a professional fund manager. You have somebody doing that for you. Diversification. Because they invest in different asset classes or different industries, that means that the volatility that I talked about can be reduced, because if one investment doesn't do as well as the other, you find it tends to balance out. That's what we call diversification. So they diversify your risk. And the benefits that you get include convenience, because whether it's a retail or an institution, you as an investor can purchase any mutual fund very easily. And you don't have to, it doesn't have to be as complex as if you're investing on the stock market and you have to look and see which stock to buy and all of that. A mutual fund, it gives you like a basket of goods, a basket of assets. So it's a nice mix. And therefore, it's more convenient for you especially as a retail investor like ourselves, it's convenient. And of course, it's very easy to purchase a mutual fund. They're offered at mutual fund companies and banks. So for instance, if you bank with FCB, there's Abercrombie Fund. If you bank with RBC, there's Roytrin. The banks offer their own mutual funds. So if you're already a client of the bank, it may be easy for you to just stay with that bank and purchase a mutual fund, or you could shop around and purchase a mutual fund from some other institution. It's very easy to open an account, usually 2 forms of ID and proof of address, and a low minimum initial investment. So you can start off a mutual fund with $100, and you can just top it up as you go by. So another financial myth: once I find a product I like, I'm going to sink all of my money in it. Remember what Granny used to say. Don't put all your eggs in one basket. Diversification is the key. Invest your savings in different asset classes like equity, debt, and real estate to beat inflation and create wealth. Remember, it's not just saving. Saving alone won't do it. Investing in the right financial instruments will help secure your financial future. So when we look at assets, a bank deposit doesn't grow much in value and can depreciate based on inflation. Real estate appreciates in value over time. Equity generally generates growth, but they can provide you with income by way of dividends. And the debt instruments, like the bonds, they provide income and then they give you back the principal that you would have put out. Now, when you're looking at these assets and risk, equities, of course, is the higher risk. It's very volatile. Debt is low risk. Even if, let's say you purchase a government bond, even if that government goes out of power, the new government that comes in is obligated to honor the bond. Cash, low risk in the sense of if you put your cash in a bank, we have a very strong financial sector, and you put your money in the bank, you could go and take it out. You could take it out by swiping your card, etc. So there's low risk in that regard. And of course, real estate, low risk, and high possible profitability. So in the rules of investing, we always recommend that you pay off any high interest rate debt that you have your emergency fund before you even start thinking about investing. When you're thinking about investing, think of your objectives, the timeline, and your risk tolerance. But be rational about what you expect. Some people want to invest today and become a millionaire tomorrow. It doesn't work that way. And remember that there are no guarantees when it comes to investing. So if you're risk averse, you may want to consider mutual funds or some other investment opportunity that is less risky than the stocks. But you could also remember, automate your investing so that you don't have to think about it so much. It just automatically goes. And of course, you need to always be mindful of the market. So you can't just invest your money and turn your back and forget about it. You need to do some reading, look at financial news, just keep an eye on things. Check in every so often with your financial advisor to ensure that everything is still going according to plan so that you can adjust if you need to. All right? At no point should panic be your investment strategy. So let's talk about debt. What is debt? Usually debt is money owed by one party to another. And sometimes debt is used to purchase, large items that you can't afford in other circumstances. And there's an agreement between the borrower and the lender that you have to pay back the money at a particular time. It is very rare that the debt is forgiven by the lender unless it's your mom or some family member. Usually it has to be paid back and with interest. When we look at credit cards, a lot of consumers spend money that they don't have. It's easier to do it because they have lines of credit via credit cards, and the bank encourages you by offering increased lines of credit even when you don't ask for it. And sometimes, if you're not careful, you overuse or abuse your credit card, and only too late you realize that you're drowning in debt. So how do we fix this? Where do we begin? Make a list of all your debts. Include the creditor's name, your total balance, how much you need to pay monthly as a minimum, what is the interest rate for each one, and then do a total of all your debts. Sometimes it's very eye-opening to see how much debt you're really in. You should calculate your debt service ratio. This is the ratio of your debts to your income. So it measures your ability to service that debt. How do you do it? It's your fixed monthly debt over your gross income. So here we have an example. Let's call your gross income A, your monthly expenses B. It's B over A multiplied by 100 gives you your DSR. Generally speaking, persons with a debt service ratio between 35 and 40% or above are likely to be turned down for loans. Now, there are some institutions that will offer you a loan even if your debt service ratio is 75%. But understand that the interest that they're going to be charging you to get that money is astronomical. So if you have debt, you need to have a debt payoff plan. If you have a large amount of debt, if you have many sources of debt, you need to figure out what is it that you have to pay, how much you need to pay in order to eliminate your debt, and in which order you need to pay them. So debt management can include loan renegotiation, loan deferrals, or debt consolidation. In the loan renegotiation, you're talking to the lender and you're explaining what the situation is, and you're looking to renegotiate the terms of your loan, right? So there's a discussion between the lender and the borrower. The lender can modify the terms, whether it is the length of the loan or the amount that is paid. And they usually do this in agreement. Both parties have to agree to modify the terms of the loan. Why will they even consider this? Because at least that way they're still getting some cash flow coming in. And in the event, let's say it's a loan that has a security, an asset tied to it as collateral, they really don't want to go through the hassle of trying to sell that to recoup. So if you talk to your lender and you can make an arrangement, this is an option for you. So either the interest rate or the maturity, the payment schedule, all of these things can be modified, but you can decide, I don't have money to pay my loan this month now, so yeah, what, later for them, yes? I will pay next month. You can't do that. Once you have that agreement, it is better to go in and explain your situation, and hopefully you all can come to some kind of agreement. During COVID, you had an opportunity for a loan deferral. A lot of the financial institutions allowed persons a temporary fix where they allow you to skip payments. I think the most some people did was like for 3 months, you didn't have to pay, but you can't decide to do that on your own. You have to talk to the lender. What this does is it gives you some breathing room, so you don't have, to worry for at least 3 months that, you have this money to pay and you don't know where you're getting it from. It also doesn't charge you any late fees. So that's good. It means that because you have an agreement with the lender, there's no late fee when you haven't paid. They have agreed with you that you're not going to pay for this period of time. And of course, they're not going to come and repossess the collateral. The thing with the loan deferral, however, is the interest is still running. So sometimes they've extended either the term of the loan. So let's say the 3 months you didn't pay adds on 3 months to your loan. So if your loan was going to end in 2028, December, it may now end in March 2029. Some persons do a balloon payment. A balloon payment means that still ends in 2028 December, but it is the loan payment that is due in that month plus the 3 months that you didn't pay. So these things you need to discuss with your lender and make sure that you understand the terms and conditions. Now, debt consolidation is where you have multiple debts. And if you look at the example on the screen, so in this case, there are 3 different debts, and you now consolidating that into one debt. So what happens here is the lender will calculate all of your debt, pay off all of that debt for you, and you now owe the lender, you have one loan with that lender. So it's usually a very good idea for borrowers who have high interest loans. You have a single payment, your stress is reduced, because I think we all know if you have 3 and 4 different loans that are due and you're struggling, you tend to be stressed. Because you now have one single payment, you have a lower interest rate, because some loans may be 24%, 12%, 15%, And now you have one loan that might be, and if you go with your credit union, you know it's 1% on the reducing balance. So you have a lower interest rate than the interest rate you have to pay on these several different loans. It may expedite payoff. Nobody's going to be running you down to collect whatever the item is that you may have purchased. And of course, it improves your credit score. On the other side, however, remember that you may have had 3 loans, one ending December this year, one ending mid-June next year, and the other one ending in the next year, right? With the debt console, you now have one loan, but that loan may be for 5 years. So it may be longer than the longest debt that you had before, but it still is better because you only have one loan to pay. And all of that interest payment that you've been paying on the others, you no longer have to deal with. But even more important, if you don't deal with the underlying financial issue, why you got yourself into the trouble in the first place, you could fall back into debt again. So debt consolidation works, but you should also have some financial counseling going along with that. And I know that your credit union can provide that. So when you're looking to reduce your debt, sometimes you, having done the calculations and you've documented all of your debts, etc., there are 2 methods that you could use to reduce your debt. You have the snowball method, which is where you pay your debts off from smallest to largest. Don't care what the interest rate is. So you list those debts in that order. You make minimum payments on all the debts except the smallest one. The smallest one, you try to get rid of it as fast as possible. Once that debt is gone, you take that payment and you put it to the next smallest debt, and you keep doing that. So the more you pay off, the more your freed up money goes, and they liken it to a snowball rolling downhill. Why do we do it this way? If you're trying to pay the biggest debt first, sometimes it takes so long, you don't get the traction. You might get disheartened. It's important for you to pay your debts in a way that you keep motivated to wipe them out. So by paying off the small debt first, you get a quick win and you feel, you light a fire, as I say, light a fire under you to pay off the remaining debts. Of course, it doesn't reduce the interest as much as the other method that I'm going to talk about. So it might take longer to become completely debt-free, but it does build the motivation. Now, the avalanche method. This is where you're looking now at your interest rate, and you decide to pay on the highest interest rate debt as fast as possible, and you just paid minimums on all the other debt. Once you clear off that high interest rate debt, you pay on the next highest interest rate debt. And what happens here is when you pay off a big debt, you tend to feel, a little bit more in control. So it gives you a little, plus. But it requires a lot of discipline and commitment. The thing is, it generally reduces the amount of time it takes to get out of debt. So if you're very budget-oriented, this can work for you. So this is a side-by-side image that shows the difference between the two. So this is a good example of how each one works. The avalanche attacking the highest interest rates, the snowball attacking the lowest balances. And I know you all are going to get the presentation afterwards. So this is an important slide to recall. So I want this not to be you. I did some financial planning and it looks like I can retire at 97, debt-free, and live comfortably for 11 minutes. I don't want that to be you. So take advantage of all of the financial literacy information you can. Speak with your credit union, get financial counseling, get financial advice, and let's become debt-free Let's become wise financial consumers as we proceed through life. And with that said, I thank you very much for your attention. Your credit union is there to help you. Talk to them. Understand what they're offering you. Take your loans for productive purposes. Explore solutions to better manage your debt. Over to you, Anne.
Thank you, Arlene. That was a wonderful session. The information was most valuable, and we thank you so very much for joining Aero Services Credit Union this afternoon to share that information. Well done. For persons who are online, Aero Services Credit Union is located at the corner of Orange Grove Road and Priority Bus Route, Tacarigua. We're directly opposite the Etihad grounds. And the credit union has a motto where it says that we are enriching the lives of our members. One of the takeaways that we would have gotten from Arlene here is in terms of budgeting, investments, and actually debts. And no one of us here wants to live to 97 and have 11 minutes to be free. None of us. Before we go further, is there any questions for Arlene at this time? All right, so I'm not seeing any questions, but Arlene in the
There are
chat.
questions in the chat.
Okay. All right. So I'm seeing a question, what's your personal interest rate for personal loans like medical expenses? Our personal interest rate right now is 0.5% on the reducing balance. All right. Arlene, I'm seeing that the presentation was well laid out. Persons are putting in the chat on the presentation, and I agree. So we were going back in terms of some of the takeaways and looking at how we move forward. Now, Aero Services Credit Union is in the process of lending to its members and also persons who are coming into the credit union. The credit union has currently a debt consolidation loan, and I'm just going to share my slide with you on the loan. The debt consolidation loan is to assist members and members to consolidate their debt so they can actually start saving some monies, because that is also an aspect of our product where it is that you pay your loan, but you also have to save. We have the loan that goes up to a maximum of $350,000. You have up to 180 months to repay. This can be used to clear off other loans, higher purchases, and as Arlene would have indicated, there's the snowball method and the avalanche method that you can use. You can get up to $42,000 cash in hand with a minimum share contribution of $500. So based on what we would have heard here today, this is a great product for persons to start budgeting, looking at their debts, and aligning their monthly expenses. All right? So I'm seeing some questions in the chat. How do I join ASCU? From Kim Joseph. Kim, you can join Aero Services Credit Union. You can go online. It's job letter, payslip, 2 forms of ID, and a recent utility bill. And you come into the credit union with a minimum of $50, and you can be a member of Aero Services Credit Union. Okay. Since we have no more questions in the chat at this time, I would like to
There's a question from Davin in the chat.
Yes, Davin, Yes, we do offer mortgages, and it is at a 4.99%. Our mortgages have fixed rates, meaning that your rate does not increase over the years as compared to other methods. So it's 4.99 fixed rate, and it will go up to your age of retirement. The rate of interest for the debt consolidation, there are some variable rates. So what you can do, you can call the office at 640-6416, and you can get some more information. Or you can also go online. There's a pre-assessment form that you can submit, and someone will contact you. All right. Okay, so I'm not seeing any more questions, but I would like to thank each and every one of you for joining Aero Services Credit Union today with our Let's Talk Money Habits for Life webinar, and hope to see you soon. Thank you very much, and good night to everyone.
Good night.
Good night.